Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment, would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get in for new episodes and other videos. So let's begin. Like always, I'm going to use the website known as lazyfa.com, which allows me to see all these financial numbers in an easy visual format. Today, we're going to take a look at Verizon, and we're going to take a look at some of the new features that were added to LazyFA, which are going to add so much more details to these videos. So let's begin. Alright guys, so here we're at Verizon. We're going to take a look at their income statement, balance sheet, cash flow statements, and then we're going to take a look at some of the new features here on LazyFA. So here we're starting off with income statement, right? And they just reported their last quarter four a few weeks ago. So we're going to take a look at the annual data instead of the quarterly data. There might be some times where we'll take a look at the quarterly data, but during the main episode, we're just going to take a look at annual data. So here we can see revenue. Revenue last year was 126 billion. This year 130 billion, a nice increase of about $4 billion. That's good to see this growth. Unfortunately, that cost of revenue, like always, seems to be growing. We grew revenue by about 4 billion, 4.8. Cost of revenue itself grew about $2.5 billion. So that's great to see our gross profit increasing throughout the years. But I would like to have seen a bigger increase, right? Cost of revenue is definitely playing a big part. Gross profit this year was 75.36 billion. Last year was 72.97 billion, almost 73 billion. So we can see gross profit is increasing. We can see here though, the first thing that came to my mind was net income. Net income dropped from 30 billion last year to 15 billion this year. So I was wondering where that money went. Luckily here we saw earnings before income tax, and we can see earnings before income tax were pretty much on par from last year. Last year was 24.88 billion. This year was 23.95 billion. 1 billion less earnings before income tax. So that to me told me that there was a change somewhere in their taxes, and that's what caused that net income to drop. And if here we take a look at tax expense, we can see last year there was a tax expense of negative $9.96 billion. So this company got about $10 billion of a tax refund pretty much last year, where this year they're paying $3.5 billion. So a delta of $13 billion, which if we were to add that delta of $13.5 billion, we would have about $29 billion in net income, which is not too far from the $30 billion that was collected last year. So we can see here there was this huge tax expense. But if we take a look at the 2016 net income, we can see the net income there was 13.13 billion compared to the now 15.53 billion. But we can see that year it was also a higher tax expense. It was actually $4 billion more on tax expense. So if we were to add that, that would be about 17 billion. So it does seem like net income, if we take a look at both years, it is decreasing compared to the previous years. So that's definitely not a great thing to see, but the net income itself, outside of earnings before income tax, here we can see that would be here, right? Earnings before income tax, we can see it's decreasing a little bit over time, but it's not a huge drop that can really trigger a flag for me. Next, we'll take a look at some of the red flags, right? This is a great thing LazyFA gives us. And first, we start off just with revenue versus cost. Here we can see revenue is such a huge factor compared to cost. It's close to a 1 to a 2.5 ratio. Cost revenue this year was 130. Cost of revenue was 55. We can see we have a positive gross profit of 75 billion. Great to see. Revenue versus cost growth. This is just giving us percentage-wise. It does seem most of the time cost of revenue is growing at a faster rate than revenue itself. But when revenue is that low compared to when cost of revenue is that low compared to revenue itself, obviously a small increase in cost of revenue is going to give us a higher percentage wise compare. But at the moment, there's nothing outrageous here if we're taking a look at the annual data. Let's just keep going down. Here we can see gross margins and profit margins. Here we can see, unfortunately, we have this downtrend in gross margin, but it does seem to be slowing down over time. Last year, gross margin was 57.9. The year before that was 58.2. This year was 57.6. So it is decreasing, but it's still within its high 50s gross margin. That's not, again, nothing outrageous for me to see here. Unfortunately, profit margins have changed. This year is higher than 2 years ago, and it's still lower than 3. So in 2018, the end of 2018 of this year was 11.9%. The year 2 years ago was 10.4, and the year before that was 13.6. I'm not taking a look at here in 2017 because it was 23.9%. That was a huge profit margin increase, and to me, it's an outlier that I don't really want to calculate. So here we have some red flags. Lazy FA is just telling us, hey guys, take a look at these, and there might not be anything, but it's just an extra set of eyes. So here, right, it's just telling us cost of revenue is growing at a faster rate than revenue itself. We took a look at that, but we noticed that, right, revenue itself is still such a huge value compared to cost of revenue itself. Now we have outliers in share outstanding growth. It's just telling us in 2014, the end of 2014, this company, I guess, diluted some shares, increased the amount of shares dramatically, and it's just throwing us this flag. But if we look at it in the few years, this year increased its shares by 1.0, pretty much 1%. Not a huge change. Excessive dilution alert, again, same thing as the previous alert. All right, so next, this is one of the new features. It's been added some time ago, but it's the first time I'm using it. Here in Lazy FA, they have chart machines, so we're just going to take a look at the actual expenses themselves. We can here see we're taking a look at SG&A. All right, so here we're gonna use now for the first time the chart machine charts. All right, guys. So here we're gonna use a new platform now that Lazy FA has, the chart machine. We're gonna take a look at just some of the expenses, just so we can see visually a better concept of what the expenses are for the company and see if there's any difference or any huge change going out throughout the years. So we're going to take a look at SG&A, which is selling, general, and administrative expense. We're going to take a regular operating expenses, which include wages and similar stuff like that. We're going to take a look at interest expense and tax expense. We can see, right, everything is pretty much growing in the past 3 years in this uptrend. So they're increasing their operating expense, which we've seen. They're increasing their selling general expenses. They're also increasing their interest expense. But at the moment, nothing here, right? If we take a look at it with just the eye, there's nothing here outrageous. The only outlier here would be this tax expense, and we saw that in the net income, and that's why the net income changed, because they had more of a refund last year on tax expenses compared to every other year. Next, we're going to take a look at the balance sheet. Here in the balance sheet, we'll take a look at total assets, liabilities, debt, receivables, payables, and cash equivalents. So here we're taking a look at total assets. We can see assets are increasing. That's definitely good to see. And this is even better. While assets are increasing, total liabilities are decreasing. So assets this year were 264.83 billion. Last year was 257, a healthy increase of about $7 billion. Total liabilities this year's 210 compared to last year's 212, a decrease of $2 billion. Again, that I like to see that a lot, where we're increasing our total assets and decreasing our total liabilities. Next, we have total debt. Here we can see we're paying off some of our total debt. Last year was 117 billion. This year was 113. I just want to take a look. Quarterly data. Every quarter it seems to be paying off little by little. So receivables, the amount of cash this company receives throughout the years, pretty healthy. 10 billion is increasing. Payables, again, also increasing the amount of money they have to pay their vendors. Cash and cash equivalents compared to last year is high, as it's high compared to last year. Right now it's sitting at 2.75 billion. Last year was 2.08 billion. Unfortunately, I feel like this is pretty low of cash and cash equivalents for a company that has so much money in total assets. So we'll take a look at their asset breakdown in a bit, just to see how their total assets are broken down. Here we're going to take a look at the red flags of Lazy FA of Verizon, and here we can see total assets and total liabilities. We can see there was a point where here in 2015, the end of 2015 and 2014 and 2016, where assets and liabilities were closing together. That gap, it was almost a 1-to-1 ratio, but in 2017 and now in 2018, that gap is getting a little bigger, which is great to see. And in return, we're having that shareholder equity. We can see here in 2000 and the end of 2014, the shareholders equity was 12.3 billion. And just a quick reminder, shareholder equity is the difference between our assets and our liabilities. And then every year ever since, we've increased that gap. We're at $53.15 billion, almost an increase of 4 times, 400% in the past few years. So that's definitely great to see. And here we can see assets versus liability growth. We're looking at annual data, so let's take a look at sequential opposed to period to period. And we can see on the sequential growth, total assets have been growing at a faster rate than liabilities. Liabilities seem to be decreasing over time, which is again a great thing to see. So here we'll take a look at the asset distribution and liability distribution. A huge portion of this company is intangibles, which is at 52%, sitting at $128 billion. The rest is property and equipment, sitting at 36%, and that's about $89.29 billion. What is the next biggest thing is receivables. Receivables here, we're at 25.1 billion, about 10%. So those three alone make about 95% of this company, maybe a little more, about 52 plus 30, yeah, about 98%. Right? Am I right? About 98% of this company is made out of those three things. Unfortunately, this company, right, intangibles, I guess you can't really put a price on a network itself, but it seems they're able to. But at the same time, I hate to see a company have this much assets based on intangibles themselves. Liability distribution, we can see a huge portion. Let's see if I'm seeing this right. Yep, a huge portion is non-current debt. So non-current debt right now is at 105.87 billion. That's about 62.5% of its liabilities. But we can see it's been decreasing over time. Last year was 113 billion. This year was 105. So this company is paying its off its debt. We can see this year it has a current debt of $7.19 billion, which is about 4.25% of this company's liabilities. And we can see the major players here are the non-current debt at 62.5%, payables at 13.29%, and tax liabilities at 20%. So let's see here. We have some red flags right now. And here the first flag is just telling us liabilities over time over the past few years have been growing at a faster rate than assets. But that seems to be a problem only in 2013 and 2014. But if we take a look at the past 3 years, we can see that that's not the case. So to me, this flag, thank you for telling me, but it's not really important. Overweight and intangible, this is something we've definitely took a look at, and we can see here total assets, a huge portion is intangible, more than 30%. So it's just telling us, hey, take a look, make sure that the assets, right, it's just telling us to take a look at the assets and to take a look that they're doing great. Here we have outliers in cash balance. If we take a look at the bar, we can see why there was a huge gap in 2013 where there was a huge amount of cash and cash equivalents, and then we see that number drop dramatically, and it's just telling us, hey, these guys are doing something fishy. And the same thing between cash growth, we can see here that that cash and cash equivalent growth in that year made about 1,000%. So it's just telling us, hey, this makes no sense. So again, none of these flags right now are really scaring me. The only thing here right now that I don't like is this asset distribution based at 51% are intangibles. All right, guys, so here we're going to take a look at Lazy FA's chart again. We're going to take a look at return earnings, current debt, net cash flow from operations, and repayment of debt securities. Excuse me. So here we can see return earnings, right? So this is this is money the company keeps, and it keeps for further growth of the company instead of giving it as dividends or some other aspects. So this is great to know that this company is increasing its retained earnings. This company is keeping its money to keep growing, and I definitely like to see that in a company. Obviously, if it's just giving it to shareholders, to me, it means this company does not know what to do with its money. So instead, it's giving it back to the shareholders so they won't complain. But here, where they're keeping their earnings and they're going to use it for something else, hopefully growth in the company. And that's what most likely is going to happen. Next, I wanted to look at current debt. I wanted to see what was the current debt this year. So right now we're sitting about $7.19 billion. Last year was $3.45 billion. I just wanted to make sure this company had enough cash for it to pay this current debt. And here we can see the cash flow from operations, this tan color. So it increased over time. So this company definitely has enough money to pay off its debt. It's current debt, right? So an increase of $4 billion in current debt, but an increase of almost $10 billion in net cash flow from operations. So I'm not worried at all about this company being late on paying any payments. So the company is looking good on that part. Then just again, issuance and repayment debt security. I just wanted to see how the finance net cash flow from finance was handled. All right, so next, again, finally, we're at the cash flow statement. So here in the cash flow statement, I usually only took a look at net cash flow from operations. And here we can see this healthy increase. I love this, right? Last year was 24 billion, this year's 34, a nice increase of $10 billion, which is about 4% or 40% increase. That's definitely a great thing to see. And now I'm going to start definitely taking a look at net cash from finance. This is payment backs on any long-term liabilities or current debts. So we can see this year they paid negative $15.38 billion for cash back. Obviously next year they're going to pay some more, but this company again seems to have the money to do so. All right, guys, so just a quick recap of what we saw. An income statement. In the income statement, we saw an increase in revenue, an increase of cost of revenue, but we have the nice healthy gross profit, net income. We saw why we have this. So the things. Okay, guys, so a quick recap on the things I really like. First, in the income statement, I like we're having revenue increase. I'm liking that a lot. Cost of revenue and gross profit are also increasing. And here we can see, right, that revenue at the moment is is a huge factor compared to cost of revenue. So I'm definitely liking that. I'm also liking we have our gross profit increase. A few things I'm not liking about the revenue. The income statement is this net income. All right, guys, so just a quick recap. The things I like about the income statement, we have that revenue increase, right? We have that gross profit increase. If we take away the outlier of last year's net income due to that tax expense, net income itself is increasing compared to 2016. So to me, that is a big plus. What I don't like about the income statement, there's not really much I don't like about it. That is pretty much that is scaring me away from uh from the company itself. Anything else I might have missed? Nope, that seems pretty straightforward. All right, in the balance sheet I'm liking a lot. We have our total assets are increasing over time. Total liabilities are decreasing, which means our total debt is decreasing. One thing I do not like about this is our cash and cash equivalents and how that's such a low percentage of this assets and how such a high percentage of the assets in this company is based on intangibles. That to me is something I don't like, but it's not a scary thing looking at everything else. In the liabilities section, we can see non-current debt is a huge portion, but this company definitely seems to have enough money to pay for it. Again, shareholder equity, another thing I do like. We're seeing that shareholder equity gap increasing between that total assets and that total liabilities, giving us at a higher value of shareholder equity. And right now, it is at all-time high. We're all, like we mentioned, assets seem to be increasing at a faster rate compared to liabilities. So that great things for Verizon. If we take a look, another thing we like, I'm liking the retained earnings where this company is keeping its money for further growth. This current debt means nothing to its net cash flow from operations. This company has enough cash to pay off its current debt. Here in what I'm like from the cash flow statement is we have that net cash flow from operations at a positive and it's increasing over time. And due to all these things I like, I would definitely give a Verizon a buy. And because of that, that means if I'm looking for another investment, Verizon would be the next one I'll take a look at. So I hope you guys enjoyed the episode of Verizon. It was definitely a little longer than most episodes, but I provided a lot more details in this episode. I hope you guys enjoyed it. Make sure to subscribe to get more info on more episodes. Like I said, I would definitely buy on Verizon based on the information we just saw. Now I wonder, what would you guys do? Would you buy or pass on Verizon based on the financial documents we just saw? Have a good night, and again, don't forget to hit that subscribe button and like. See you guys next time.